Hi, in this recording, I will present the paper titled The Economics of Security Analysis, joined with Kowei Ho, Haitao Mo, and Chen Xue. The paper has just been accepted for future publication at Management Science. So what we do in this paper is to show that the investment CAPM in which expected returns vary with investment, profitability, and expected growth cross-sectionally provides an equilibrium foundation for Grant and Dot. The outline of the presentation is as follows. So I will first describe the background information about security analysis to motivate our analysis, and then I'm going to describe the equilibrium theory behind our theoretical framework, and then I'm going to use the investment model to explain quantitative security analysis strategies. Next, I'm going to use the investment model to explain active discretionary funds, and finally, I'm going to address some of the accounting issues that have been raised in the recent literature for our factors. So motivation, security analysis is extremely well-known, and Grant Dot, 1934, is the classic textbook on security analysis. Grant's 1949 classic titled The Intelligent Investor is more written for the mass audience, whereas security analysis is more technical textbook. So more recently, Margin of Safety is another pretty well-known book among value investors. And then finally, Value Investing from Grant to Buffett and Beyond by Bruce Greenwald and the co-authors. They just published the second edition last year, and the fairly extremely influential book. So the basic idea of security analysis is fairly well known. So you ought to invest in undervalued securities that are selling below the intrinsic value. The intrinsic value intuitively is that value that can be justified by a firm's earnings, assets, and other accounting information, basically fundamental information. And the intrinsic value is distinct from the market value that is subject to artificial manipulation and the psychological distortion. So, and when going after these undervalued securities, we ought to keep in mind the concept of margin of safety, that your intrinsic value estimate ought to be comfortably higher than the ongoing market value before you go long. So Grant Dot have in mind clearly the intrinsic value is different from the market value. So famous writings, famous passages from their book. So I'm going to be citing out of their second edition, which is generally considered to be more authoritative. The market is not a weighting machine on which the value of each issue is recorded by an exact and impersonal mechanism in accordance with its specific qualities. Rather, should we say that the market is a voting machine, where on countless individuals register choices, which are the product partly of reason and partly of emotion. So in Grant's 1949 Intelligent Investor, he goes on to say another famous parable. One of your partners named Mr. Market is very obliging indeed. Every day he tells you what he thinks your interest is worth, and further offers either to buy you out or sell you additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects, as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away from him, and the value he proposes seems to you a little bit short of silly. So in Warren Buffett's 1984 article, The Super Investors of Grant Dottsville, Buffett writes that our Grant Dot investors, needless to say, do not discuss beta, the CAPM, capital asset pricing model, or covariance of returns among securities. these are not subjects of any interest to them. In fact, most of them would have difficulty defining these terms. So the traditional view within security analysis literature is that it's diametrically opposite to efficient market hypothesis. So this the same interpretation, same dominant view in the accounting literature as well, both in terms of teaching and the scientific literature. So here's an influential textbook by Steve Penman, Financial Statement Analysis and Security Valuation. So Steve writes that passive investors accept market prices as fair value. Fundamental investors, on the other hand, are active investors. They see price is what you pay, value is what you get. They understand that primary risk of investing is the risk of paying too much or selling for too little. The fundamentalist actively challenges the market price. Is it indeed a fair price? So again, intrinsic value and the market value are divergent. So in the academic finance literature, the view is more reserved vis-a-vis the efficaciousness of the usefulness of fundamental analysis. So I've been using Bodick and Marcus to teach investments for 20 years. So one of their paragraphs, they write that the efficient market hypothesis predicts that the most fundamental analysis also is doomed to failure if the analyst relies on publicly available earnings and industry information. His or her evaluation of the firm's prospects is not likely to be significantly more accurate than those of rival analysts. So they were actually pretty careful, Bodick and Marcus. They say they don't come out and say fundamental analysis doesn't work. They just say most fundamental analysis also is doomed to failure, but you can clearly sense their reservation, their implicit reservation towards fundamental analysis. So most of the time, and you read their textbook, you get the impression that they remain skeptical about the active investment. All right, so that's the background of security analysis, most of which is fairly well known. It's in the prior literature. So what do we have to say about the status quo? So I'm going to describe our equilibrium model that I call the investment cap-in. What's the essence? Well, I'll go relatively quickly in this presentation because some of these ideas, some of these points have been discussed in my prior presentations. So I'm using the same causal structure to cover different aspects of reality, and the simplicity is probably a good thing. Two parallel interpretations of any cross-sectional predictability. We know realized returns equal expected returns plus abnormal returns, right? So the point of the consumption cap-in is really to show that time-varying expected returns, so the stock market being excessively volatile, according to Shiller, may not be mispricing because expected return can be time-varying. So by the analogous reason, I'm trying to show in different papers, that the expected returns are also cross-sectionally varying. Okay, cross-sectionally varying. Therefore, all kinds of cross-sectional anomalies. They are anomalies to the cap-in or consumption cap-in. They are actually irregularities within the context of what I call the investment cap-in. In other words, we rely on the expected return channel. All the anomaly variables are actually connected with the expected returns. We do not interpret the anomalies as predictable abnormal returns because that would be implying forecasting errors are forecastable, and that's a violation of rational expectations hypothesis or efficient market hypothesis. The bottom line is that within the investment cap-in, expected returns are functions of accounting information. So the demand theory of value, I'll go quickly. So you can write down the problem for any marginal investor. So on this slide, I'm just using a representative household. As you will see in most of the asset pricing textbooks at the PhD level. You can also write down a financial intermediary problem, and something really similar is going to pop up. So at the end of the day, you're going to have conditional expectation of pricing kernel, some type of pricing kernel. Could be a function of aggregate consumption or some consumption of some marginal investor, or could be leverage ratio of a financial intermediary. All right, so it's a function of that, and you get to consumption CAPM or any demand-based theory of a CAPM. So at the end of the day, some form of risk is going to show up. So I'm gonna work with the supply theory of value. Individual, this is basically a stripped down version, and simply based on optimal capital budgeting. Right, so it's extremely simple. You can add many more complications with the corporate finance type of frictions. So we have X dividend firm value plus dividends are going to equal to operating cash flow minus capex minus adjustment costs, and plus the next period continuation value, and the world lasts for only 2 periods, and you have operating cash flow next period discounted by the pricing kernel, and you can prove that this under constant return to scale. That's a technical condition you will need to jump pricing kernel altogether. With the decreasing return to scale, even increasing return to scale, with decreasing return to scale, my sense is that it's going to be fairly close. The equality is going to be fairly close as well. I haven't seen much about the increasing return to scale as something interesting to explore in future research. So bottom line is that you're going to see a net present value rule. So what I call the investment CAPM is basically a restatement of the net present value rule in corporate finance. So the demand in equilibrium, of course, demand and the supply of any risky assets have to be equal, right? So at the end of the day, you're going to two sides. So buy side, you're going to get the consumption CAPM or intermediary CAPM or any other CAPM. And on the supply side, you're going to have what we call the investment CAPM, right? So they're going to be equal. Supply equals demand. So in our writing, current writing, we basically argue covariances, expect returns, and characteristics are all simultaneously determined in equilibrium. You cannot say firm A has high expected return because firm A has higher risk. Okay, because risk is endogenous variable. So on the other hand, I've been studying philosophy of science for a while now, for almost 2 years. I have a little bit more understanding about causation. Okay, so actually the structural model, this is a causal structure, right? So beta and expected return are causally linked because the consumer is doing the utility maximization, right? It's the mental states are actually causes, right? So this is a causal relation. We can indeed talk about causal relation. The same applies to the firm side as well. So investment profitability and expected return are correlated because the corporation is maximizing its shareholder value. Right, so that's a causal. The model, the structural model, is actually a causal structure. So we can indeed talk about causation, causal mechanism. I follow the causal powers theory of causation. Harry, Nancy Cartwright, and Roy Baska. So these are all famous philosophers of science. So in a multi-period model, and this is our Q5 paper, so you have, so next period investment in the numerator, and again, so cross-sectionally vary expect returns. So then we implement the factor model on top of that, and this is our Q and the Q5 model. Right, so and you can already clearly see how grand dot security analysis can be mapped into our equilibrium economic theory, right? So and keep in mind our ROE factor and expected growth factor. So these are both of them feature prominently in Grant Dott's writing. For example, on page 353, Grant talked about the trend of new earnings. A new concept was given central importance, that of trend of earnings. The past is important only insofar it showed direction in which future can be expected to move, right? In the Q factor paper, we are using past ROE as a proxy for expected profitability, right? So a continuous increase in profits proved that the company was on the upgrade and promised still better results in the future than had been accomplished to date. Again, ROE is fairly persistent. The productivity is fairly persistent at the firm level, especially at the higher monthly or quarterly frequency. So earnings power. So the definition, the concept of earnings power, another paragraph on page 506 in the second edition of security analysis. The concept of earnings power has a definite and important place in investment theory. It combines a statement that actual earnings show over a period of years with a reasonable expectation that this will be approximate in the future, all right, unless barring extraordinary circumstances. So expected earnings power, right? So this is clearly central concept of investment CAPM as well. On the other hand, the Grant argue for bargain prices, right? You have to buy stocks with higher earnings, trend of earnings, higher earnings power, but you need to pay particular attention on the current price. Assuming a fair degree of confidence on the part of investor that the company will expand in the future, what price is he justified in paying for this attractive element, right? So obviously, if you can get the good future for nothing, you would go for it, but this may not be the case, of course, if market itself is counting on future growth, meaning the current market price is too high, and then you really have to figure out whether it's worthwhile, whether the bargain price you feel comfortable to go with your expected earnings. Grant also talked about the expected growth risk. So once the investor pays a substantial amount for the growth factor, this should be, let me clarify, this is actually expected growth factor. This is, we're talking about the future, right? He's inevitably assuming a certain kinds of risk. This, that the growth may be less than he anticipates, that over the long haul, long pool, he may have paid too much for what he gets, and therefore for a considerable period, the market will value the stock less optimistically than he does. So expected growth could be risky. All right, so to summarize, the investment CAPM, in which the expected returns vary with investment, profitability, and expected growth cross-sectionally, provides an equilibrium foundation for Grant, right? So we, according to the investment CAPM, we recommend investors to buy high profitability, high growth stocks at the bargain price, and such prescription is identical, is virtually identical to Grant more than almost 90 years ago. So on the other hand, we differ in essential aspect. Grant, their writing predates equilibrium theory under uncertainty by 20, 30 years, right? So they implicitly assume a constant discount rate, right? So thereby they attribute all the predictability from fundamental analysis to mispricing. We are arguing, of course, easy for us to say because we are building on equilibrium theory for the past half century. So we're gonna argue that, wait a second, expect returns all vary cross-sectionally, just like expect returns are varying in the time series, right? That's the consumption CAPM's response to Shiller's excess volatility puzzle. We are trying to argue that the cross-sectionally varying expect returns seem to be a nice response to the anomalous literature, right? So whereas on the other hand, so this is the So vis-a-vis our response vis-a-vis the traditional grand dots security analysis literature. On the other hand, we also differ from the consumption CAPM literature in mainstream asset pricing theory, because as noted in the MBA level textbooks on investments, so using CAPM as the workhorse theory model, because CAPM doesn't really model fundamental accounting information, right? At the end of the day, Bodick and Marcus end up at least downplaying, if not dismissing outright, the importance of fundamental analysis. As a result, fundamental analysis is not being taught in the finance departments. Fundamental analysis is being taught in the accounting departments, right? But all these things were all staring at the same social reality. So all the different strands of scientific knowledge are all interconnected. So we're gonna synthesize everything. We're gonna attempt to synthesize everything together. A little bit of Hegelian dialectic. Thesis, antithesis, and thesis. So bottom line is that differently from differing from consumption CAPM, we're gonna embrace and validate security analysis on equilibrium grounds. All right, so let me get to the numbers. So first, let's look at the quantitative security analysis strategies. We're gonna be using the Q5 model as our workhorse empirical model. Why not? It is the best effective model, in our opinion. All right, so we're gonna pick the most prominent security analysis strategies, right? So this is the list. So Ababane and Bushi, very, very influential article in 1998. I think it's at the Accounting Review, if my memory serves me well. So, so this is the definition. All right, so let me get to slides +2 first. So they pick their fundamental signals from a prior study by Lev and Tyagarajan. So apologies to the author for mispronouncing his name. So we had dinner once in a conference, so we're friends. All right, so 1993, Journal of Accounting Research. So they select signals based on financial analysts' written pronouncements, and they show they use their judgment based on written pronouncements. They picked 7 or 8 signals, and they show that these signals are value relevant. So accounting terminology, meaning the signals are significantly associated with contemporaneous stock returns. Value relevance means contemporaneous correlation with returns. Subsequent stock returns, that's forecasting. So Ababane and Bushi 97 article shows that the value relevance of the signals is actually related, is due to their associations with subsequent earnings changes. Okay, and these associations are the key premise of fundamental analysis, right? What is fundamental analysis? They're trying to analyzing subsequent fundamental changes, mostly earnings, right? So the 97 article shows that, right, it is indeed due to fundamental analysis, in the sense that you can use these signals to forecast future earnings change, right? And finally, in their 1998 Accounting Review article, they make the next necessary step. Natural step is just to use these signals to forecast subsequent returns, all right, to the extent they show the evidence to be reliable, and they interpret the evidence as investors underreacting to earnings news, right? So we're going to argue, right, so signals are part of expected returns through the channels of expected profitability and expected growth. And that's indeed what we see in the evidence. So if you see so we are doing 3 by 5 sorts on size and their composite score. They have 7 or 8 different signals that are written down here. Again, they are following the prior 1993 Journal of Accounting Research article. Though I would probably do it differently, because some of the signals are defined in a way that are at least debatable, to the extent that you see they have actually not exactly subsequent earnings changes. Well, let me take that back. So it's much more complex. I should put it that way. But bottom line is that if you look at the high minus low composite score based on their metrics all combined together, the profitability is actually not that strong, right? It is significant, but the high minus lows are, we're looking at 16 basis points per month and 22 basis points per month. And our factor models reduce them, not by a whole lot, but sufficient to make them insignificant. If you look at the factor loadings, the ROE factors are pulling the most of the weight. Expected growth factor shows up occasionally as well. However, the investment factors are going the wrong way, right? So this could explain why their high minus low average returns are not too high. So this is why I was saying earlier that their signals are a bit mixed up together, right? So I would, if I were writing, of course, easy for me to say. This is more than 20 years ago. They are prominent article that I'm really fond of. So right, so they are, but we can still criticize the substance in the sense that the different signals are combining signals that are riding on our ROE factor and some of which are riding on the investment factor, right? So they're a little bit of a mixture. So that's probably the reason they are loading in different directions. As a result, the average high minus low average returns are not too high. So again, I don't mean to criticize their work, and again, so it's my way of showing my respect. So that's, their work is really highly influential. All right, so let me move on to Franco and Lee paper, another hugely influential paper in the capital markets literature in accounting. So what they did is to estimate intrinsic value using accounting model, residual income model, and this is their implementation. They estimate a little bit simplistic, but to do empirical work, and you have to make assumptions, and that's just totally fine. So intrinsic values, so they implement the 2-period version. So rigorously speaking, residual income model is infinite horizon, right? So, but to get the ball rolling, they implement the 2-period residual income model. So again, their paper was published in 1998. That's, 25 years ago. Is easy for us to come back and criticize because due to our hindsight bias. Because we were building on the scientific development in the past 2 decades. So, but this is how they estimate the intrinsic value. VH in intrinsic value, that's book value, and that's ROE, and that R is the discount rate, which they assume to be a constant of 12% for everybody and across all time, right? So, and because of that assumption and many other different assumptions, there, for example, terminal value, right? So some of the valuation papers assume 12 years ahead of time, and then at the end of 12th year, you make a terminal value assumption. So as a result, we view the intrinsic value to market estimate mostly as a nonlinear function of investment, profitability, and expected growth. So profitability is directly here, and there's also expected growth buried somewhere in future book value. of equity. And of course, once you scale everything by market equity, and then the book to market is going to show up as part of our investment factor. Okay. So we view the intrinsic to market ratio mostly as a nonlinear function of our key expected return drivers as opposed to literally intrinsic value, right? So because in our theory, rigorously speaking, the intrinsic to market value is 1 because there's no mispricing in the model. The intrinsic value equals market value. This is within the model. I'm not saying it doesn't exist. In reality, most likely mispricing does exist in reality, but the question is whether we can use our model to explain the empirical performance. The answer is actually yes. So the high minus low average returns work. Although in recent years, value has been taking a beating. It's pretty well known. If you look at the Q5 alphas, they're insignificant, although they are not small. So, but the most of the time, if you look at the factor loadings, the investment factor is doing most of the work, right? ROE and expected growth going the other direction is not surprising. Well, I misspoke. It is a bit surprising, but on the other hand, the expected growth factor is tiny. Is not that big. The ROE factor is not. The factor loadings are not that big either. So most of the time, so yeah, the magnitude 15 is not small, but the other two estimates are small. So most of the time, the intrinsic to market the effect anomaly is explained by our investment factor. All right, so the next security analysis strategy we looked at is Joe Greenblatt's famous magic formula from his book, A Little Book That Beats the Market. So Joe argues that you ought to buy a good company at bargain price. Good companies identified as having high returns to capital, and bargain price are basically defined as bargain prices are identified as high earnings yield. And we follow his definition in the appendix of his 2010 version, the second edition of the book. And we put everything together. And his Greenblatt strategy does work. You see the high minus low. So these are average returns. They are reasonably big and significant, but our Q5 model reduces things to insignificance and ROE and the expected growth factor. So mostly ROE factor is doing the job, and because Greenblatt's magic formula is a combination of returns on capital, not exactly ROE, but quite close. And the bargain price at earnings yield, that's basically a value metric. And then that's picked up by our investment factor. So a combination of investment ROE factor, a little bit of expected growth as well, does the job in shrinking his alphas to insignificance to us and the small magnitude as well. So Aslis, Frazzini, and Peterson. So this is the quantity minus Zhang strategy. So quantity is defined as characteristics that investors are willing to pay a high price for. So there are 3 dimensions of quantity: profitability, growth, and safety. And profitability is measured by an array of profitability variables: gross profitability, ROE, return and cash flow to assets, gross margin, and negative growth. Growth, I should highlight, this is actually past growth. So this is past 5-year growth based on, all this profitability measures, but defined using residual per share basis. And the third dimension is safety, right? So in our replication, quantity minus Zhang at the one-way sort is not super strong. So, but it's definitely something there, 25 basis points and t-value 1.74. So a little bit bigger, well, quite a bit bigger in micro caps. So small firms as well, 37 basis points and t-value 2.9. But our Q5 model does a pretty good job. Other than micro caps, in which we only we have a t-value 2.02, so every other aspects we shrink alphas to a small magnitude, and the t-values below 1. And you can see based on our factor loadings, it's a combination of ROE factor and expected growth factor that does the job, right? So investment factor is a little bit going the wrong way. And we looked at some of the details. We have some discussion in the paper. So the negative loading on investment is actually due to their growth score. So they are using past 5-year growth, past growth over 5-year horizon. That actually it's just past growth, right? It's not expected growth. So expected growth is picked up in their measurement from cash flow to assets, which is related to our operating cash flow to assets. But their past growth captures just our investment factor, not the expected growth, and the capturing investment factor in the wrong direction, because past growth means high past investment, right? Because our investment factor is low minus high, it loads the wrong way. So we end up suggesting that, look, perhaps their growth score can be improved somewhat going forward. Instead of past growth, we ought to be looking at expected growth. So we don't have strong sense of safety. Our sense is that it's probably it's a combination of investment and ROE factor, and we know that the betting against the beta factor can be captured that way. So Bertrand and Greenblatt agnostic analysis. So this is what they did, right? So at the beginning of each month, they also estimate the intrinsic value, but unlike Franco and Lee paper that is based on residual income model, parametric model, you have to throw in a lot of assumptions. But Chang and Greenblatt say that, look, let's just use mechanical algorithm, right? Let's just pick all the available compute stat items, as long as they're not redundant, and throw them together. And each month you cross-sectionally regress beginning of the month market equity on a long list of accounting variables. And you estimate the intrinsic value simply as the fitted component. That's what it did. Okay, intrinsic value. So the deviation is basically, right? So the minus p piece doesn't really matter. Is at the end of the day, this is exactly V over P, basically intrinsic over market value measure. So which they call agnostic. Agnostic in the sense that they are using a statistical model as opposed to residual income or other valuation model. So their strategy does work. Especially in the two-way sorts, you see significant t-values and sizable average returns. And in our Q5 regressions, so other than, well, I guess 36 basis points, alpha is not small either, but it's not significant. Actually, we're not doing anything there. So in terms of average return versus alpha, but among small stocks, we do better. So 27 basis points, alpha t-value of only 1.3. So, and in terms of factor loadings, our investment factor is doing most of the work, a little bit of ROE as well. So again, so the intrinsic to market strategy is a value strategy at the end of the day, and our investment factor captures a lot of the action. In particular, if you look at the micro caps, right, it jumps all the way from 81 basis points to 42 basis points in terms of Q5 alpha. So we are inspired by Ray Ball's 1978 article, and we looked at the operating cash flow to market. All right, operating cash flow. So we use Ray Ball and co-authors 2016 definition. So basically, you start from you stay away from bottom line earnings. You just use cash flows, and that's the detailed definition. And we show that from 67 to 2020, the high minus low operating cash flow to market earns 10.64% per year, as opposed to 3.46 per year for book to market. So we end up concluding that the operating cash flow to market is a better measure for value premium than book to market, most likely because operating cash flow better captures the impact of intangibles on value than book to market. And building on Steve's 2009 writing. So the basic idea is that, right, because of the rising intangibles, book equity is not as useful as before. However, the point is that take Coca-Cola, although brand capital is missing from the balance sheet, but you can still ascertain the value of the brand capital from sales or from cash flows. Probably even earnings, right? Although advertisement expenses are taken away from earnings, and the sales operating cash flows will be more reliable, will be more useful in capturing some of the impact of intangibles. So, Nerd is kind enough to write the Bloomberg article that describes our article. In terms of high minus low strategies, the operating cash flow to market works pretty well. So a pretty powerful measure of value. Small stock 61 basis points, one-way quintile saw the 49 basis points. And the Q5 model, again, does pretty well other than microcaps. So it's a combination of, it's mostly value matrix. Value strategy, and therefore our investment factor is doing most of the work. A little bit of expected growth as well, because operating cash flow is this operating cash flow to asset measure is a key predictor for future growth in our expected growth factor. Right, let me look at the next strategy is Penman and Zhu article. So they use accounting model. So they have a fundamental strategy also. So basically, this is the definition of return, right? So you can just rewrite this, and then they argue based on intuition that the changes of market to book in terms of the difference. The change in the difference between market value and book value is related to expected growth, expected earnings growth, and the details are described. The detailed intuition is described in our paper. So in this sense, you can see that in their model, they still have market equity in their model. And from this perspective, we argue that our model, the investment CAPM, is actually more fundamental because we do not have market equity in our formulation. So because we managed to substitute out, so value and investment are redundant, right? So within the context of the model, my understanding is that some of the evidence is in the data as well, right? So we use the first order condition for investment to replace market equity as marginal cost of investments, and that's just the increasing function of investment. So Penman and Zhu go on and construct the expected growth proxy from projecting future returns on 8 accounting variables that are a priori connected to future earnings growth. They have a first stage regression, regressing future earnings growth on a bunch of variables, and then they pick 8 variables that are most connected to subsequent earnings growth, and then they then work with these 8 variables, and they're using a projection regression method to construct using the fitted component as expected return proxy. All right, so there are quite a bit of details that you have to be careful vis-a-vis the timing. The details are in our paper, and you can take a look if you are interested. But the bottom line is that you combine the average slopes, right, from the prior 10-year rolling window with the variables, right? So you have to be make sure that they're from fiscal year ending from the prior fiscal year, and then you form the expected return proxy. So in terms of high minus low average returns, you can see that their measure does work. So high minus low one-way sort in terms of quintile, high minus low is 54 basis points per month, and mostly show up, you know, they're all significant in the two-way source as well, right here. Our Q5 alpha, other than microcaps, we do a good job in explaining their high minus low average returns to insignificance. So a combination of so a little bit all over the place, but the investment factor is doing most of the work, and a little bit of ROE and expected growth, although it's going in different directions. On the other hand, if you look at the one-way source, the expected growth factor loading is significant, but the investment factor loadings are most consistent. Why is that? If you look at there are 8 variables, right? Are mostly investment variables, right? So right, so the value, earnings to price ratio, book to market, and this value, basically another name for investment. Accruals are basically working capital investment, although a little bit more complicated. Accruals can be quite a combination of different things. ROA, and then you see ROE shows up, and net external finance, again, highly correlated with investment. So is net share issues. Right, so that's the intuition why the Q5 model captures their expected return strategy pretty well. All right, so let me head into active discretionary funds. So this step is actually quite important, and we've been inspired by Richard Sloan's 2019 article at the Accounting Review on fundamental analysis redux. So Richard's central insight is that look, security analysis requires a ton of qualitative information, right? That requires a huge amount of business judgment. So it's impossible that you can just write an algorithm that code up how the brains of Warren Buffett and Charlie Munger would work, right? That point we totally agree, right? So Sloan's argument, Richard's argument is that, look, you cannot, so algorithm, so the mechanical algorithm, quantitative approach, it's you cannot use that as a replacement for qualitative security analysis. That we totally agree. So that said, we looked at some of the top active equity funds, right? So we do not have their detailed holdings, okay, but we do have their returns. We do observe their returns, right? So we looked at all the active equity funds in the CRISP mutual fund database, and we sort all the equity funds based on their information ratio. For life information ratio, basically capital alpha divided by residual risk. It's a measure of active investment. So here's the list. The best performer has a monthly, this is amazing, monthly information ratio of 30%. This is pretty high, right? And these are the top 20 funds. So if you look at some of the evidence we have compiled together, so what about aggregate active funds? So this is all the, not just top 20, this is all the active funds aggregated, both equal weighted as well as value weighted, total net assets weighted, we call that value weighted, right? So we see that aggregate funds about break even before fees. After fees, they actually underperform the market in terms of the CAPM alpha. You see CAPM alpha is weakly negative and the value weight is actually significantly negative. So this is all consistent with the Bill Sharp's arithmetic of active management. So active management is basically a zero-sum game. You are competing among yourselves. So we also notice another interesting pattern that is that the aggregate portfolio, our investment and expected growth factors are actually both significantly negative. All right, I'll come back to this point. Whereas if you look at the top 20 active funds, so this is the top 20 out of close to 2,000. So we're literally looking at top 1%, right? Close to top 1% of the performer, top 1% performers. So their average returns are pretty high, okay? 1% per month, right? CAPM alpha is also pretty high, whereas, so these are the Q5 alphas. So they represent a significant reduction from average returns, sizable, although magnitudes are lower than the case for average return. For CAPM alpha, the reduction for Q5 alpha is also quite noticeable, ranging from 29 to 56% is probably, so these are, reasonably big. But more importantly, so we highlight in the paper that look at our expected growth factor. They're significantly positive. And keep in mind, in the prior slide, we reported that the expected growth factor at the aggregate level is actually significantly negative, right? But for top performers, they are top performers partly because they're loading up heavily on expected growth factor. So the investment factors are also positive, although they are insignificant, right? However, if you look at the aggregate portfolios, the investment factors are actually significantly negative, right? So that's an important empirical finding we highlighted in the paper, that the aggregate fund portfolios, active fund portfolios have significantly negative investment and expected growth factor loadings, whereas the top 20 fund portfolios have significantly positive expected growth and positive albeit insignificant expected factor loadings. In other words, the top funds are buying high expected growth at bargain prices. Okay, so top funds outperform through high expected growth and the low investment or low price stocks at the expense of other funds who hold the opposite sides of the trades in equilibrium. Okay, so why opposite sides? Because the aggregate funds have the opposite loadings than the top funds loadings. So, and given active management is mostly a zero-sum game, so the game of the top funds is the expense, it's the loss of other funds who are trading against them. So we also looked at the Buffett alpha. So we first replicate the AQR paper that shows that within their sample, the AQR 6-factor paper actually explains Buffett alpha in terms of alpha is 45 basis points per month and the t-value is 1.67. The average return is 1.51% per month. So there's a big reduction, although once we extend the sample back to 68, using whatever data we can find from both CRISP and CompuStat, so the alpha actually goes up to 58 basis points and marginally significant. Okay, so the Q factor alpha is actually quite similar, 45 versus 47, 47 versus 45, and the Buffett's Berkshire Hathaway is basically buying high ROE stocks and the low investment stocks, high profitability stocks at bargain prices. And this is quite consistent with the Buffett-Munger value investing philosophy. Although once we throw in expected growth factor, our alpha actually goes up because our expected growth factor has a negative loading, although insignificant. So, and again, once we extend the sample, everybody's alpha becomes higher. So we interpret the evidence as saying, right, the quantitative investing goes some ways. I would say go a long way, but it's impossible to fully capture the qualitative analysis that embedded in Buffett's investment. Right, so the last section of the presentation, I'm going to be talking about the accounting for asset pricing factors. In a series of articles, Penman and co-authors, they've been criticizing the accounting treatment of our factors. So testing the investment campaign requires auxiliary assumptions on investment, profitability, and expected growth, and this is just the nature of scientific work and the scientific theory. To test the theory, you have to take the theory to the data, right? You have to make assumptions. You have to take an empirical stance on the measurement. So in particular, we measure investment as total asset growth. We're not accounting for expense investments like intangible investments, right? We're not taking account R&D, advertisement, or organizational capital investments, or this intangible investment forecast returns with a positive slope. I should say tend to forecast future returns with a positive slope. And Steve pointed out, hey, this is inconsistent with your investment theory. On the other hand, then Steve highlights that, but that's consistent with accounting conservatism in the sense that the tangible investment, right? That accountants feel pretty comfortable about the future payoffs of tangible investment. They feel comfortable putting tangible investment on the book, on balance sheet, whereas the more risky with more future uncertain future payoffs like intangible investment, like R&D, for example, accountants would just expense them right away. This would be accounting conservatism, and they imply actually risks, which of course we totally agree. Tangible investment means less risk than lower risk than intangible investment from the accounting conservatism. So our point is that is actually quite consistent with the investment theory as well. So our investment factor also implies a negative investment return relation, although we take a minimalistic approach vis-a-vis the pricing kernel. But if you put the pricing kernel there, you're going to see a negative correlation, right? You're going to see negative correlation between investment and risk. So intangible investment are incorporated in the Q5 model, not through the investment factor, but through our expected growth factor, because we use operating cash flow. Rayborn co-authors 2016 GFE article, we're using operating cash flow as a key predictor for future growth. That's a key component of expected growth, right? And that adds back R&D, not SG&A. So therefore, intangible investment, that organizational capital investment is not captured, or advertisement is not captured. On the other hand, it's notorious to figure out which fraction of SG&A is intangible investment, right? And take Super Bowl ads, for example. Now it's really hard to disentangle which fraction of that Super Bowl advertisement will deliver current period sales vis-a-vis future period sales, right? The current period sales, you ought to be matching that with your current period expenses. in accounting, only the part of advertisement that delivers future period sales should be considered as intangible investment, but that disentanglement, that separation is actually pretty tricky. So we're going to take the stand, we just ignore it. We just take the simple approach using operating cash flow. Right, that's what I just explained, the third bullet point. So we totally agree with the Penman that tangible investment, the intangible investment should not be summed up, right? So Steve makes his argument based on accounting conservatism. We are making our argument based on economic theory. So the tangible investment and intangible investments forecast returns in different ways, in different directions. They are really heterogeneous capital goods. They should not be summed up. You are mixing up all the pricing information. All right, so let me conclude. So in this paper, we show that the investment CAPM provides an equilibrium foundation for Grant Dodd's security analysis. And therefore, security analysis should work within efficient markets to begin with, because of cross-sectionally varying expected returns, while challenging the mispricing paradigm from Grant Dodd. We completely agree with Sloan's argument that active discretionary management is indispensable for well-functioning capital markets, and the active management cannot be completely replaced by quantitative, more or less passive investment. Right, so let me end the presentation with the cliffhanger. And so I'm working on my first ever philosophical paper, currently tentatively titled Critical Asset Pricing. So by calling it critical, so doesn't mean criticizing prior work, although I have to do plenty of that in the paper. So critical, by naming the paper critical, I'm paying my respect to Immanuel Kant's critical philosophy and Roy Bhaska's critical realism philosophy of science. So the investment capital literature is fighting on three fronts. Okay, so we are having a hard time. We have had a hard time publishing this article. I'm grateful that the management science has finally accepted our work. The peer review process, it's very informative, but occasionally you have to persevere. You have to take the comments in goodwill, right? So so that's in that spirit, that's what we are trying to do. And I'm very grateful for all the critical feedbacks and comments we have received, and we are working diligently to adjust them in our subsequent work, right? So the investment CAPM is debating on three fronts simultaneously. So, and you would, so it's not surprising. So this paper is having a hard time, has had a hard time. So we're fighting against consumptionism, which is the term I name, the implicit philosophy of science underlying the consumption CAPM, most important of which is the notion that asset pricing is all about pricing kernel. No, it's not. Okay, so we're gonna have a point. We're gonna have a counteraction to that. We're also debating with behavioral finance in their argument that in their conclusion that investors make systematic mistakes. They probably are, but we're going to separate the efficient markets hypothesis from investor irrationality. So we are also debating with the empiricism, which I call Humean, I should say Humean empiricism. Hume as in David Hume, that in the sense that observed factors are all we can learn about the reality. I'm an empiricist myself, but I'm very comfortable taking in metaphysics, ontology, and economic theory and whatnot. So in the new paper I'm writing, Critical Asset Pricing, so I asked a Kantian transcendental question. Okay, so we ask, what must the financial reality be like for asset pricing anomalies to be possible? So I'm going to end up with the conclusion that corporations, not the investors, are the causal powers of asset prices, especially of their own stocks. By moving the center of gravity from Earth-centered, the human-centered view to corporation social structure-centered view. So I argue all the asset pricing anomalies, all the debates we've been trying to sort out ever since the 1980s. Most of these anomalies, debates can be resolved. And I call the shift from human-centered view of the world to corporation to non-human-centered view of the world as a Copernican revolution in finance. So stay tuned. Thank you.